Every financial crisis has a cause. The Great Depression, bank failures and deflation. 2008, subprime mortgages and Lehman Brothers. But Black Monday has no clear trigger. The economy in October 1987 is strong. Unemployment is low. GDP is growing. Corporate profits are up. Yet on October 19th, markets collapse. 22.6% in one day. Economists are baffled. Politicians demand answers. The Brady Commission investigates. Their conclusion is shocking. Nobody knows exactly why it happened. There were contributing factors, rising interest rates, trade deficits, computerized trading, but no single cause. Black Monday is a mystery crash, a day when markets panicked for reasons that remain unclear. This is the story of October 19th, 1987, the crash that defied explanation. And the terrifying realization, if we do not know why it happened, we cannot prevent it from happening again. Let us rewind to August 1982. The United States is emerging from recession. Interest rates, which peaked at 20% under Federal Reserve Chairman Paul Volcker's inflation-fighting crusade, are finally falling. The stock market, beaten down for over a decade, begins to recover. The Dow Jones Industrial Average starts August 1982 at 776 points. It is the beginning of one of the greatest bull markets in history. Over the next 5 years, the Dow will nearly triple, reaching 2,722 points by August 1987. Why the boom? Multiple factors converge. First, inflation is tamed. Volcker's aggressive rate hikes in the early 1980s crush inflation from 13% to under 4%. With inflation controlled, the Federal Reserve cuts rates. Lower rates mean cheaper borrowing. Companies expand. Investors buy stocks. Second, the economy is strong. President Ronald Reagan's economic policies, dubbed Reaganomics, include tax cuts and deregulation. Critics call it trickle-down economics. Supporters say it unleashes business. Regardless, the economy grows. Unemployment falls from 10.8% in 1982 to 5.9% by 1987. GDP expands at 4% annually. Third, corporate profits soar. Companies benefit from lower interest rates, lower taxes, and reduced regulation. Earnings grow. Stock prices follow. The S&P 500 delivers average annual returns of 26% from 1982 to 1987. Investors who stay in the market become wealthy. Fourth, new technology transforms trading. Personal computers appear on trading desks. The Quotron machine provides real-time stock quotes. Information that once took hours now takes seconds. Traders can react faster. Markets become more efficient, or so everyone believes. Fifth, portfolio insurance emerges. This is critical to understanding Black Monday. Portfolio insurance is a strategy where investors use futures contracts to protect against losses. If stocks fall, the futures gain value, offsetting the decline. It sounds brilliant. Institutional investors love it. Pension funds adopt it. By 1987, $60 to $90 billion in assets are covered by portfolio insurance. But there is a problem. Portfolio insurance only works if markets are orderly. If everyone tries to use it simultaneously, it breaks. Nobody realizes this. Yet, by mid-1987, the bull market is maturing. Valuations are high. The Dow's price-to-earnings ratio exceeds 20, above historical averages. Some analysts warn the market is overheated, but optimism prevails. Reagan is president. The economy is strong. What could go wrong? August 1987. The Dow hits an all-time high, 2,722 points. But cracks are appearing beneath the surface. First problem, interest rates are rising. The Federal Reserve, concerned about inflation creeping back, raises rates. The 10-year Treasury yield climbs from 7% in January to over 10% by October. Higher rates make bonds more attractive than stocks. Investors start shifting money. Second problem, the dollar is weakening. The Plaza Accord of 1985, an agreement among major economies to devalue the dollar, is working too well. A weak dollar makes U.S. exports cheaper, but imports expensive. Inflation risks rise. Investors worry the Fed will raise rates further. Third problem, the trade deficit. America is importing far more than it exports. The trade deficit balloons to $170 billion annually, a record. Politicians blame unfair trade practices, especially by Japan and Germany. Tensions rise. Talk of tariffs and trade wars spreads. Fourth problem, geopolitical tensions. The Iran-Iraq war is ongoing. U.S. Navy ships are in the Persian Gulf. In July, the USS Stark is hit by Iraqi missiles, killing 37 sailors. Markets shudder but recover. Still, the Middle East remains a powder keg. Fifth problem, market volatility increases. In August and September, the Dow has several triple-digit down days. This is unusual. The market is swinging wildly. Technical analysts note bearish patterns, but most investors dismiss the concerns. Corrections are normal in bull markets, right? By early October, the Dow has fallen from its August high of 2,722 to around 2,500. A decline of about 8%. Not catastrophic, just a healthy correction, or so it seems. On October 14th, Wednesday, markets drop sharply. The Dow falls 95 points, 3.8%. It is the largest point drop in history at that time. The trigger: proposed legislation to limit corporate takeovers. Takeovers have been a major driver of stock gains. If they are restricted, stocks could fall. Fear spreads. Thursday, October 15th, markets stabilize but remain nervous. Friday, October 16th, more declines. The Dow drops 108 points, 4.6%, the second largest point drop ever. By Friday's close, the Dow is at 2,247, down 17% from the August high. Traders go home for the weekend worried but not panicking. Corrections happen. The fundamentals are still strong. Monday will bring clarity, or so they think. October 17 and 18, 1987. Saturday and Sunday. Markets are closed, but tension is building. On Sunday, Treasury Secretary James Baker appears on television. He warns that the U.S. might let the dollar fall further to address the trade deficit. This alarms investors. A falling dollar could mean inflation. Inflation could mean higher interest rates. Higher rates could mean lower stock prices. Meanwhile, overseas markets are already falling. In London, the FTSE 100 drops. In Hong Kong, the Hang Seng plunges. Asian markets open Sunday night ahead of the U.S. On Sunday evening U.S. time, Tokyo's Nikkei falls 2.4%. Hong Kong drops 11%, then trading halts. By Sunday night, Wall Street traders are getting calls. Asian markets are crashing. Europe will likely follow. Monday morning in New York will be brutal. But how brutal? Nobody knows. Most assume it will be bad but manageable. A 10% drop maybe. Painful but survivable. What they do not realize is that a perfect storm is forming. Rising interest rates, trade tensions, overvaluation, technical selling, portfolio insurance, and a new factor, program trading. Program trading is automated. Computers execute large orders based on algorithms. If certain conditions are met, the computer sells. No human judgment, no hesitation, just execution. By 1987, program trading accounts for a significant portion of volume. It is designed to improve efficiency, but in a panic, it accelerates declines. Portfolio insurance firms have pre-programmed sell orders. If stocks fall past certain levels, the computer automatically sells futures contracts. This is supposed to protect against losses. But if everyone is selling simultaneously, futures prices collapse. When futures collapse, stock prices follow. A feedback loop. Sunday night, some traders realize what is coming. They cannot sleep. They call colleagues. They pray. Monday morning will be historic. They just do not know how historic. October 19th, 1987, Monday morning, 9:30 a.m., the New York Stock Exchange opens. Chaos. Sell orders flood the market. Massive sell orders. Billions of dollars. Market makers, the specialists who match buyers and sellers, are overwhelmed. There are no buyers. Everyone wants to sell. Nobody wants to buy. Within minutes, stocks are plunging. Blue chip companies, the safest stocks, are falling 5, 10, 15%. Smaller stocks cannot even open. The specialists cannot find buyers. Trading is delayed for hundreds of stocks. On the floor of the New York Stock Exchange, panic. Traders shout. Phones ring incessantly. Screens flash red. Grown men are crying. Some are frozen, unable to process what is happening. One trader later describes it. I have been on the floor 30 years. I have never seen anything like this. It was terror. By 10 a.m., the Dow is down 100 points. By 11 a.m., 200 points. The selling is relentless. Every uptick is met with more selling. Portfolio insurance algorithms are triggering. Computers are selling futures. Arbitrageurs, seeing futures fall, sell stocks. The feedback loop accelerates. Program trading amplifies the panic. Computers do not panic. They just execute. Sell, sell, sell. Human traders cannot keep up. The market is moving faster than anyone can process. By noon, the Dow is down over 250 points. 10%. It is the worst day in decades. But the day is only half over. In Washington, officials are monitoring the situation. The Federal Reserve, the Treasury Department, the Securities and Exchange Commission. They are preparing for the worst. But they cannot intervene directly. Markets must find their own level. All they can do is ensure liquidity, make sure banks have cash, make sure the system does not freeze. Back in New York, the selling continues. 1 p.m., 2 p.m., 3 p.m., no relief. Every rally is crushed by more selling. The Dow is down 300, then 400, then 500 points. It is unimaginable, historic, catastrophic. By 3:30 p.m., 30 minutes before the close, traders are numb. Some have stopped watching. Others are calculating losses. Fortunes are vanishing. Careers are ending. Decades of work, gone. At 4 p.m., the closing bell rings. The Dow Jones Industrial Average has fallen 508 points, from 2,246 to 1,738, 22.6%. In one day, it is the largest single-day percentage drop in history. Worse than any day in 1929. Worse than any day ever recorded. $500 billion in market value has vanished. The floor of the New York Stock Exchange is silent. Traders stare at screens in disbelief. Then someone starts clapping, slowly, sarcastically. We survived, barely. October 19th, 1987, was just the beginning. As U.S. markets closed, the crash spread globally. In Europe, markets had already been falling during their trading day, reacting to Asia's overnight plunge. But when news of the U.S. crash hit, panic intensified. London's FTSE 100 fell 10.8%. Frankfurt's DAX dropped 7%. Paris fell 9.7%. In Asia, where Tuesday was already underway, the carnage continued. Tokyo's Nikkei fell 14.9% on Tuesday, its worst day ever. Hong Kong remained closed. Australia's market fell 25%. New Zealand fell 29%. By Tuesday morning in New York, investors faced a terrifying question. Would the crash continue? Monday was catastrophic, but if Tuesday brought more selling, the entire financial system could collapse. Tuesday, October 20th, U.S. markets open. The first hour is brutal. The Dow falls another 100 points. Panic selling resumes. It looks like 1929 all over again. But then something happens. The Federal Reserve acts. Chairman Alan Greenspan, just 2 months into the job, issues a statement, the Federal Reserve, consistent with its responsibilities as the nation's central bank, affirmed today its readiness to serve as a source of liquidity to support the economic and financial system. It is a simple statement, but it is powerful. Greenspan is saying, we will not let the system collapse. Banks will have cash. The Fed will provide whatever liquidity is needed. Major banks start buying stocks, not because they want to, because the Fed has encouraged them to. It is an unofficial coordination. The Dow stabilizes. By the close, it is up 102 points. The crash is over, for now, but the damage is done. Globally, over $1 trillion in wealth has vanished. Pension funds are devastated. Individual investors are ruined. The psychological scars will last years. In the weeks after Black Monday, the question everyone asks is, why? What caused the crash? The economy is strong. No bank failures. No corporate scandals. No obvious trigger. So why did markets collapse? President Reagan appoints a commission to investigate. The Brady Commission, led by former Senator Nicholas Brady, spends months analyzing the crash. They interview traders, regulators, economists. They review trading data. They study portfolio insurance, program trading, market structure. Their report, released in January 1988, identifies several contributing factors but no single cause. First, overvaluation. By October 1987, stock prices are high relative to earnings. The Dow's P/E ratio is 23, well above the historical average of 15. The market is expensive. A correction is overdue. Second, rising interest rates. The Federal Reserve's rate hikes make bonds more attractive than stocks. Money flows out of equities. This puts downward pressure on prices. Third, trade deficits and dollar concerns. The weak dollar and large trade deficits create uncertainty. Investors worry about inflation and economic instability. Fourth, portfolio insurance. This is the smoking gun. When markets fell, portfolio insurance programs automatically sold futures. This drove futures prices down. Arbitrageurs, seeing cheap futures, sold stocks to buy futures. This drove stock prices down further, triggering more portfolio insurance selling. A vicious cycle. Fifth, program trading. Computers amplified the decline. Automated selling happened faster than humans could respond. The market was moving at machine speed. Sixth, market structure. The New York Stock Exchange's specialist system struggled to handle the volume. Specialists, who are supposed to provide liquidity, could not. They were overwhelmed. Many stocks could not trade. This created panic. The Brady Commission's conclusion. Black Monday was a perfect storm. Multiple factors combined in a way nobody anticipated. There was no single villain, no single cause, just a confluence of circumstances that triggered a cascade. But critics argue the report is incomplete. It identifies factors but does not fully explain why panic spread so fast. Why did rational investors flee en masse? Why did confidence collapse instantly? Some economists point to herd behavior. Markets are driven by psychology as much as fundamentals. When everyone sees everyone else selling, they sell too. Rationality disappears. Panic takes over. Others blame technology. Computers were supposed to make markets more efficient. Instead, they made crashes faster and more severe. Still others say it was inevitable. Bull markets do not last forever. After 5 years of gains, a correction was due. The only question was when and how severe. The uncomfortable truth. Nobody knows exactly why Black Monday happened. And if we do not know why, we cannot guarantee it will not happen again. Alan Greenspan became chairman of the Federal Reserve on August 11, 1987, just 2 months before Black Monday. He replaced Paul Volcker, the legendary inflation fighter. Greenspan's first major test came on October 19, 1987. As markets crashed, Greenspan faced a critical decision: intervene or let markets correct naturally. Intervening could create moral hazard. It could encourage reckless risk-taking, knowing the Fed will always bail out markets. But not intervening could trigger a depression. Greenspan chose intervention. On Tuesday morning, October 20th, the Fed issued its famous statement affirming readiness to provide liquidity. Behind the scenes, Greenspan was calling major banks, urging them to keep lending, to keep markets functioning. He pushed banks to buy stocks. He ensured credit lines stayed open. Most importantly, Greenspan cut interest rates. On October 20th, the Fed lowered the discount rate from 6% to 5.75%. More cuts followed. By February 1988, rates were at 6.5%, down from 7.25% before the crash. Lower rates stimulated the economy. They made borrowing cheaper. They made stocks more attractive than bonds. They restored confidence. Greenspan's actions worked. The economy did not fall into recession. The stock market recovered. By September 1989, the Dow was back to pre-crash levels. Within 2 years, Black Monday was a memory, but Greenspan's intervention set a precedent. The Fed would not let markets collapse. This became known as the Greenspan put. Investors believed the Fed would always step in during crises. This encouraged risk-taking. It inflated bubbles. Critics argue it contributed to later crises, including the dot-com bubble and the 2008 financial crisis. Greenspan himself later reflected on Black Monday. He said it taught him that markets are driven by psychology, not just fundamentals. Fear and greed are more powerful than rational analysis. As Fed chairman, his job was not just to manage interest rates, but to manage confidence. Black Monday made Greenspan's reputation. He was the man who saved the system. For the next 20 years, he was the most powerful central banker in history. But the seeds of future crises were planted in October 1987, when the Fed signaled it would always rescue markets. Before Black Monday, Wall Street believed technology made markets safer. Computers provided faster information. Algorithms optimized trading. Portfolio insurance protected against losses. The future was automated, efficient, rational. Black Monday shattered that belief. Technology did not prevent the crash. It caused it, or at least accelerated it. Program trading allowed computers to execute massive sell orders instantly. In the past, a human trader would hesitate, assess the situation, maybe wait. But computers do not hesitate. They execute. If the algorithm says sell, they sell. No emotion, no judgment. On Black Monday, program trading accounted for an estimated 10 to 15% of volume. That does not sound like much, but in a panic, it is massive. Those automated sell orders hit the market at the worst possible time, driving prices down faster. Portfolio insurance was worse. It was designed to protect investors. The idea, if stocks fall, automatically sell futures to offset losses. It sounds logical, but it only works if a few investors use it. When billions of dollars in assets use the same strategy and all trigger simultaneously, it breaks the market. On Black Monday, as stocks fell, portfolio insurance algorithms kicked in. Sell futures. Billions of dollars in sell orders hit the futures market. Futures prices collapsed. Arbitrageurs, seeing cheap futures, sold stocks and bought futures to lock in the spread. This drove stock prices down further, triggering more portfolio insurance selling. A feedback loop. The specialists on the New York Stock Exchange floor could not handle the volume. They were supposed to provide liquidity, buying when everyone else was selling, but they did not have enough capital. They were overwhelmed. Trading halted for many stocks. This created more panic. After Black Monday, regulators implemented circuit breakers. If the market falls too far too fast, trading pauses. This gives everyone time to breathe, to reassess, to prevent panic from spiraling out of control. Today, if the S&P 500 falls 7%, trading halts for 15 minutes. If it falls 13%, another halt. If it falls 20%, markets close for the day. Portfolio insurance disappeared after Black Monday. It proved too dangerous. But program trading evolved. Today, high-frequency trading dominates markets. Algorithms trade billions of dollars in milliseconds. Humans cannot compete. Most volume is computerized. The flash crash of May 6, 2010, showed that technology still creates risks. In minutes, the Dow fell 9%, then recovered. No clear reason, just algorithms interacting in unexpected ways. Black Monday's lesson remains. Technology can accelerate crashes. Computers do not panic, but they can create panic. And once a cascade starts, it is almost impossible to stop. Black Monday was not just an American crisis. It was global. Within 24 hours, every major market fell. The crash spread like a virus. Why globalization? By 1987, markets are interconnected. Portfolio managers invest globally. Information flows instantly. When Wall Street crashes, Tokyo reacts. When Tokyo crashes, London reacts. A feedback loop across time zones. Hong Kong was first. On October 19th, before the U.S. opened, Hong Kong's Hang Seng Index fell 11%. Trading was halted. Investors panicked. London opened next. Seeing Hong Kong's crash, British investors sold. The FTSE 100 fell 10.8%. When New York opened and fell 22.6%, the panic went global. Asia, already moving into Tuesday, crashed again. Tokyo fell 14.9%. Sydney fell 25%. Europe, opening Tuesday, fell further. Every major market was down double digits. By the end of the week, global markets had lost over $1 trillion. No country was spared. Emerging markets were hit especially hard. Investors fled to safety. U.S. Treasury bonds, ironically, surged as stocks crashed. The global domino effect revealed a troubling reality. No market is isolated. A crash in one country spreads everywhere. Diversification, the supposed protection, offers no safety in a global panic. When everyone sells, there is nowhere to hide. This lesson would be forgotten. In 1997, the Asian financial crisis proved it again. In 2008, the global financial crisis proved it again. Markets are globally connected. Crises spread instantly. Black Monday was the first modern global crash. It showed that in a world of instant communication and interconnected markets, panic moves at the speed of light. Most investors lost money on Black Monday, but a few made fortunes. How? First, short sellers, investors who bet against the market. They borrowed shares, sold them, then bought them back cheaper after the crash. Some hedge funds made millions, but most short sellers were caught off guard. The crash was too sudden. They could not react fast enough. Second, Treasury bond traders. As stocks crashed, investors fled to safety. U.S. Treasury bonds surged. Traders who owned bonds before the crash profited handsomely. Third, opportunistic buyers. Some brave investors bought stocks on Monday afternoon. It took nerve. Markets were collapsing. But those who bought at the bottom and held made fortunes. The Dow recovered within 2 years. Fourth, Alan Greenspan and the Federal Reserve. They did not make money, but they saved the system. By providing liquidity and cutting rates, they prevented a depression. The economy recovered. Investors who stayed in the market eventually made their money back. Most investors, however, suffered. Pension funds lost billions. Individual retirement accounts were decimated. Some investors sold at the bottom, locking in losses. Others held on, watching their portfolios collapse. The psychological damage was profound. Many investors swore off stocks forever. They missed the recovery. They missed the bull market of the 1990s. Fear kept them out. Black Monday taught a brutal lesson. Markets can crash faster than anyone imagines. But they also recover. Panic selling locks in losses. Patient holding, in retrospect, was the right strategy. But in the moment, on October 19th, 1987, nobody knew markets would recover. It felt like the end. Only with hindsight do we see it was just another crash in a long history of crashes. Black Monday offered several lessons. Some were learned. Others were ignored. First, valuation matters. By October 1987, stocks were expensive. A correction was overdue. Markets cannot go up forever. Gravity exists. Second, technology can cause crashes. Computers were supposed to make markets safer. They made them more dangerous. Automated trading accelerates declines. Third, liquidity is everything. When markets panic, having cash is king. The Federal Reserve's willingness to provide liquidity saved the system. Fourth, interconnected markets amplify crises. When one market crashes, all markets crash. Diversification offers no protection in a global panic. Fifth, fear spreads faster than facts. On Black Monday, markets fell for unclear reasons. Panic fed on itself. Psychology matters more than fundamentals. Sixth, circuit breakers help. After Black Monday, regulators implemented trading halts. They prevent panic from spiraling out of control. Seventh, central banks will intervene. Alan Greenspan set a precedent. The Fed will not let markets collapse. This creates moral hazard but prevents depressions. But some lessons were ignored. The Fed's willingness to intervene encouraged risk-taking. Investors believed they had a safety net. This inflated the dot-com bubble in the 1990s and the housing bubble in the 2000s. Both ended in crashes. Program trading evolved into high-frequency trading. Today, most market volume is computerized. The risks remain. The flash crash of 2010 showed that. Black Monday also showed that nobody fully understands markets. The Brady Commission could not identify a single cause. Economists still debate what happened. If we do not know why it happened, we cannot prevent the next one. The uncomfortable truth: crashes are inevitable. They are part of markets. The question is not if, but when, and whether we will be prepared. Despite the catastrophe of October 19th, 1987, the U.S. economy did not fall into recession. The stock market recovered. Why? First, the Federal Reserve acted decisively. Alan Greenspan's liquidity injections and rate cuts restored confidence. Banks kept lending. Credit kept flowing. Second, corporate earnings remained strong. The crash did not change fundamentals. Companies were still profitable. The economy was still growing. Once panic subsided, investors returned. Third, valuations became attractive. After falling 22.6%, stocks were cheap. Value investors saw opportunity. They bought. This stabilized prices. Fourth, investors realized the crash was irrational. There was no economic catastrophe, no war, no bank failures, just panic. Once they recognized this, they returned to the market. By mid-1988, the Dow had recovered half its losses. By September 1989, it was back to pre-crash levels. By 1990, it was making new highs. The 1990s bull market dwarfed the 1980s. The Dow went from 2,000 in 1987 to 11,000 by 2000. Investors who stayed in the market made fortunes. Those who fled missed the greatest bull market in history. Black Monday became a footnote. A scary day, but ultimately just another correction. Markets always recover, always. But this lesson is dangerous. It encourages complacency. Yes, markets recovered from Black Monday, but they do not always recover. Japan's Nikkei peaked in 1989 at 39,000. As of 2024, it is still below that level. 35 years later, markets usually recover. But not always. Not for everyone. And not immediately. Black Monday's quick recovery was fortunate. The next crash might not be. Today, October 19th, 1987, is remembered as Black Monday, the day markets lost 22.6%. The largest single-day percentage drop in history. But the mystery remains. Why did it happen? Economists have theories. Overvaluation, rising interest rates, trade deficits, portfolio insurance, program trading, global contagion, all contributed. But no single cause. The Brady Commission investigated for months. They interviewed hundreds of people. They analyzed millions of data points. Their conclusion, it was a perfect storm, a combination of factors that triggered a cascade. But they could not fully explain it. This is unsettling. Financial crashes are supposed to have causes. The Great Depression had bank failures. The dot-com crash had overvalued tech stocks. The 2008 crisis had subprime mortgages. But Black Monday? No clear villain. No obvious mistake. Some say it was inevitable. Bull markets do not last forever. After 5 years of gains, a correction was due. The only question was timing. Others blame psychology. Markets are driven by fear and greed. When fear takes over, rational thinking disappears. Panic becomes self-fulfilling. Still others point to technology. Computers traded faster than humans could think. Automated selling created a feedback loop. Machines caused the crash. The truth is probably all of the above, and none of the above. Black Monday was unique, a confluence of factors that may never repeat exactly, but the lessons are clear. Markets can crash for unclear reasons. Panic spreads instantly. Technology amplifies declines. Global contagion is real, and nobody is fully prepared. Black Monday could happen again. Maybe not 22.6% in one day. Maybe not for the same reasons. But another crash is coming. History guarantees it. The question is, will we be ready? Or will we be blindsided like October 19th, 1987?